Welcome back, everyone. Season 3, Episode 3 of What Are Your Thoughts? I'm excited to be here today talking about bonuses and how they're taxed. And I've had a couple client questions of various companies, whether it's, payouts and stock options, or, how, when restricted stock units vest, or it could just be an annual bonus that some employees get. And it's all about taxes. And it's interesting because you've probably heard your colleagues talk about taxation on bonuses, and they get a little upset when they feel like half of the bonus is taken away and goes towards taxes. So I'm going to talk a little bit about how it works and why it may feel like that, even though that isn't the case at the end of the year or the following year when you file your tax returns for that respective tax year. So jumping right in, I did a call last week with a client, and her bonus was about 46,500 or something. And it was in the form of stock options, and not going to cover that in this episode, but more or less going to just talk about the taxation. And so bonuses in general, and I'll keep referring back to her, $46,000 bonus as an example throughout this episode. But the general rule of thumb is that if a bonus is under $1 million, it generally gets taxed at a percentage method based on the employer. So thinking about that, generally that percentage comes out to 22%. And that is a flat tax rate. Even if your personal effective or marginal tax rate, which I've talked about in detail in previous episodes, is different. So even if your marginal or effective rate is different than the 22%, generally speaking, I've seen a lot of companies that will tax the bonus amount under $1 million at 22%. However, if the bonus amount is above $1 million, it generally is taxed at the highest rate, which is 37% for this year, above the $1 million bonus mark. So that method the employers use is called the percentage method. Now, that said, 22%, you're probably looking at your bonus like, no, it's more than that. Yes, that is true, because the 22% is only for federal tax rates. So that's the percentage method. There's a couple different methods that can be used. The other method is called the aggregate method, which I don't see as much, at least with my personal experience. Not to say that doesn't get used, but here's what TurboTax says about that method. It says the aggregate method is used when your employer issues your bonus with your regular salary payment, so AKA on the same payroll cycle. And then it uses that total amount to calculate your amount of withholding. So if you're have a super high income and you normally get 35% withheld for income taxes, that bonus amount would also be 35%. So something to think about there. That said, it doesn't necessarily mean that you're going to pay more tax on your bonus. At the end of the year, you get your W-2 or 1099 or whatever the form is, and it, when you either DIY your tax prep or use a CPA, which is recommended, it will all even out. So it's not like you're going to overpay on a specific amount. It doesn't mean it could mean you get less cash up front for the bonus, but at the when you file your taxes and look for that refund, it will come back. So there's a lot of little nuances, of course, right, with the tax code, but it's important to just think about tax rates and how bonuses are taxed in general. And so I'm going to continue with that example as well as we move forward here, that $46,000 bonus. So out of that $46,000 bonus, again, if we're using that percentage method, which is the more common one that I see, in this case, the client's tax rate was a flat 22% for federal. So the client's bonus was $46,000, and roughly have it pulled up on my screen here, but I'll just say bonus the federal tax rather was about $10,200. So that came out to exactly 22% as a flat rate. On top of that, she gets to pay her state tax, which the majority of states have a state income tax, but there are a few that don't. So if you live in a state that doesn't have the state income tax percentage, obviously there's nothing to withhold on that line. But in this case, the client was a resident in a state that does have state taxes. So her taxes for that were withheld at 5%, so another $2,300. And then on top of that, there is I'm gonna pull up her statement here, but I'll mention it. The Social Security tax. So if it's early in the year for payroll, right, where it's still February, so you might have only had one or two checks processed. So unless you're over that Social Security maximum for taxes, so how that works, and I don't mean to get in the weeds, but I think this year it's between $140,000 and $150,000 of income that you pay a 6.2% Social Security tax on. But once you're over that amount, that Social Security tax goes away. So if you make let's just say I don't have it in front of me, but I should know the number. Anyway, let's just call it $150,000 of Social Security tax. So on that first $150,000, the person pays 6.2%, and then the $50,000 over that Social Security tax goes away. And I'll look up the exact number, the Social Security tax number, and put it in the show notes. I just don't have it in front of me, and I have a bunch of other tax calculations going on. So now, okay, so recapping so far, federal tax rate was 22%. The state tax rate for this client was about 5%. The Social Security tax for this client was 6.2%. And then there's another and final tax on this bonus of Medicare tax, which was about 1.5% or $670-ish. So out of her $46,000 bonus, the total taxes due on that were just over $16,000. So this might be where people think that their bonuses are taxed at a higher rate. For some people, I suppose it could be if that 22% federal rate was, higher than what their normal tax rate would be. But if we just do the quick math on that, $16,000 out of that client's bonus was about 35% as far as taxes are concerned. So it definitely feels like the tax rate is a lot higher on those bonuses, but really once we incorporate all the different taxes inside of it, you can start to understand not where the money's going, but what percentages are being withheld. So just to recap, right, on this client's bonus and just bonuses in general, a quick little summary. So this client had a $46,000 bonus at a federal tax rate. The withholding on that was 22%. And then she had state income tax on top of that, which was about 5%. Then she had Social Security tax on top of that, which was about 6%, 6.2% of the bonus. And then finally, the Medicare tax, which was about 1.5%. So total tax rate for this client on a $46,000 bonus was about $16,000 or about 35%. So what to do there? I've had another question from clients on top of that where they might say, oh, well, I'm taxed so heavily on this, at least they think that. So why not just increase my 401k allocation and save more and get a higher match? Well, you can do that. There are definitely pros and cons of doing that. However, 401ks, the maximum for this year, if you're under 50, is if you're under 50, is $20,500. Doesn't matter which $20,500 go into your 401k from your savings, or from your paycheck rather. So at any time throughout the year, you can do that. If you put all of your bonus into that and max it out immediately, you just don't save any more into the 401k throughout the year, each paycheck, which means your paychecks will be a little bit larger. And I actually had a client mention a good point to me last week where they're like, yeah, we generally do increase the withholding because now a lot of times, I know like Fidelity, for example, is letting clients put a rate for their normal paycheck and then put a withholding for their 401k savings for their bonus paycheck as well, which is cool. And what this client does, back to that example, is they max out their 401k now, and they're like, yeah, generally at the end of the year when expenses can be the highest in November and December, our paychecks can be a little bit bigger, and therefore we can, cover some expenses. So that's not a bad strategy as well. There's other ones too. I had a client out in California where we decided to just keep the normal savings percentage in the 401k throughout the year and just keep it as is and not withhold any extra from the bonus. And there were a couple different reasons why. One of them was she was a fan of dollar cost averaging, which is just a great solution. If you're saving money inside the market, you're essentially buying every single month at whatever prices may be. So example, in November, the market hit an all-time high, and since then it's been going down for the past couple months. So each paycheck, she was purchasing shares of her investments in the 401k at different prices. And the thought is you're going to average out those purchase prices. So it's a great strategy. And it's something that a lot of clients really like and that you automatically do in your 401k every single paycheck that you save, and you don't even know it. And it's just called dollar cost averaging. And then the second one was kind of a small nuance, but it had to do with how her 401k gets matched. They did a kind of a quirky thing at the beginning of the year where then whatever they didn't match, they'll gross it up to the percentage or dollar amount that should have been matched, even if you used all your bonus to fund your 401k all at once. So it's kind of a little quirky nuance without getting into the weeds. I don't think that needs any more further discussion. But at the end of the day, should you increase your 401k percentage when you get a bonus? You can. And pros and cons, right? If we made the list, pros would be you get higher paychecks throughout the year. You take care of your savings immediately. You could make the case, and this goes against the dollar cost averaging point that I just made, you could make the case that time in the market matters, to a very high degree. So, even if you put money, you want to put money in as soon as possible to let it grow longer. And the cons of doing it, there's the other side of the coin where if you put all 20,500 in one fall swoop and the market goes down, well, you have to deal with the investor psychology on the other side of that equation, that you think, oh, well, I should have just waited, but that's so tough, right? We don't have a crystal ball. That's really the main con. I was just going to think of like another con. I guess, it depends, right? If you're saving for a major purchase, you may not want to allocate a higher percentage to your 401k. So there's a lot of nuances, and that's why, there's the old adage that personal finance is more personal than it is finance. And I would just say, if you're thinking about that, just ask the question, what might make sense to your, for your personal situation to, your financial advisor, just to make sure that they're on the same page. All right. So switching gears here to tax forms. And right now there are clients that are being notified that their 1099s are available. Well, what does that mean? And I'll post a link in show notes here. Vanguard has a nice a nice link that talks about different types of tax forms and all about the tax forms and what they might be used for. And a lot of the common ones we see our 1099-DIV, and really that's used to determine if any taxes are due on your investment income, especially from non-retirement accounts. So when I say non-retirement accounts other than IRAs, Roth IRAs, etc. So a lot of times clients will get those. 1099 INT, which is used to determine if taxes are due on investment income from bond income, fixed income investments. So look out for those. And generally with all the custodians, when you log in, there will be a spot where you can see statements, trade confirmations, and tax forms. And really you want to go into the tax forms and make sure that you download those tax forms into a PDF so that you can share those with your CPA. And one thing to look out for is that not all accounts will have a tax form. So you want to just make sure that, you're talking with your advisor, or, if you have an IRA that, didn't have any rollovers, or you didn't contribute or something like that, there may not even be a tax form. So that's important to note as well. Also, one question that I haven't gotten yet this year, but I'm sure I will get at some point, is 2021 was a really solid year in the stock market, and people might see on their 1099s that there might be a loss in the account, or a realized loss, I should say. And there's a difference between unrealized losses and realized losses. So let's say that you buy a share of stock for $100, and you bought it on January 1st of last year, and now it's $150 and for that same share, and you still hold it, you didn't sell. Well, that's generally not going to show up unless there is like a dividend paid or something. But that's not going to show up on your 1099 because, one, you still hold it. And that's just, it's unrealized. So, and two, it doesn't show up because you didn't do any type of tax loss harvesting. And I'm not going to get in the weeds on that, but basically you're still holding it. So it's an unrealized gain. However, if there were positions in your portfolio that you and or your advisor sold throughout the year and sold at a loss, that would show up on your 1099, and it would show up that you had realized losses, even though your balance of your portfolio might have gone up. So that's just the difference between unrealized gains and losses and realized gains and losses. In summary, unrealized just means you haven't sold or done anything with the shares that you own, and realized gains and losses means you did either sell out of a position or did some tax loss harvesting or something, so that on paper it looks to be that you did take a loss in any specific position inside of the account. So it is possible, again, if we were to button it up on one or two sentences, it is possible that your account value went up, but that on paper, on your 1099, there could be some losses shown. And that, again, that's just the difference between unrealized and realized losses and gains. Another one, as far as tax forms to look out for, 1099-MISC, the miscellaneous one. And that's just one that you might have in your account, and that could be for a margin account. If you had substitute payments instead of dividends for individual stocks. Again, try not to get into the weeds there. I'll cover a couple more. One of them is a 1099-R, which generally you can think of as like a rollover. And really you get issued those if if you had a retirement account and you took a distribution, you removed an excess contribution, you converted it to a Roth, or you rolled it over, right? And I just think of it, I don't actually, I'm not even sure what the R stands for. In my head, it stands for rollover, because I think of, okay, if a client rolled over an account, they get a 1099-R, they converted to a Roth, they, did that Roth conversion. And so, that is what the R means. At least in my head, that's how I remember to, know what type of tax form the client gets. The other one, or the final one that I'll talk about, is a form 5498, and that is used for calculating the total IRA contributions to the account that you have, whether it is a Roth IRA, traditional IRA, you did a Roth conversion, et cetera, et cetera. So generally what happens there is that your custodian, Vanguard, Fidelity, TD, Schwab, E-Trade, whatever, sends a copy to the IRS, and, generally you don't have to file it too with the IRS, but it's very, very important to keep track of the record keeping, aspect when, funding IRAs, because, there are times where clients might think that they have income to either make a deductible IRA contribution or just a straight up Roth contribution, and then their income ends up being too high to do so. So you really want to make sure that you have a good handle on your record keeping. So those are basically the forms. Now I'm curious. I'm going to just look up 1099-R. It's just distribution form, but I don't know. I'm going to see if I can find the R meaning. This is just saying, I don't even know. It might just be the tax code, section 1099-R, but I think of it again as rollover. So that's that one. What I will do is cut it off here, and then I'll include here in the show notes the links that I referenced here. There's a TurboTax article about how bonuses are taxed, and then there's also a Vanguard link that goes through like what different forms are. And again, if you're going into your system, there will be a tab that hopefully has statements, trade confirmations, and tax documents, and then they should also mail I think that's the one. That's the one. Tax documents are the one of those three options that also get mailed to you, even if you have the electronic delivery. So happy investing. I know it's tax season, so I hope everyone's taxes go well as far as filings go. And for those that get bonuses and things, whether or not it makes sense to increase your 401k withholding or just to understand how bonuses are taxed, I hope this episode was helpful, and we will connect with everyone next time. Thanks so much.